Please welcome the panel on Macroeconomic Outlook, moderated by Gregory Zuckerman, special writer at the Wall Street Journal.
Good afternoon, everyone. How's everyone doing? Yeah, a little enthusiasm, a little excitement. I like that. Who's not having fun at Milken? How do you not have fun at Milken? This is great stuff, right? If you're financial nerds like we all are, this is like Woodstock, right? I'm really excited to be here. I'm excited for this panel. We were talking a little bit before, and it's a group of really accomplished people with very different perspectives, both geographically and in where they sit in the world. So I love it. So I'm really excited about our panel. It's a macro panel. I thought everyone in their own words should introduce themselves, who they are and what their firm or organization does in a sentence or two, maybe three at the most. Mr. Minister, why don't you start first?
Well, thank you, Gregory, and good afternoon, everyone. My name is Khalid Al-Fallah. I am the Minister of Investment, Kingdom of Saudi Arabia, and the Ministry of Investment is a relatively new creation. We've been around since 2020, and we facilitate for investors, but we also work hard to make the Kingdom the most investable country around the world. So building on the tremendous opportunities we have, we work on regulations, incentives, ease of doing business, explaining to investors what they do, sort of a concierge service. And happy to be here, Gregory.
Thank you. Andres?
Well, I'm André Esteves from Brazil. I'm chairman and senior partner of BTG Pactual, the largest investment bank in Latin America, headquartered in Brazil. We manage about $400 billion, and both in wealth management and asset management. And we serve Latin America clients with global opportunities and global clients with Latin America opportunities.
Nice. Karen, please.
I'm Karen Carniel-Tambour. I'm Co-Chief Investment Officer at Bridgewater Associates. We're a large institutional money management firm. We manage money for large institutions all around the world, and we've been particularly focused with what's happening in the world on how to use our capabilities to enhance portfolio resilience.
Great. I'm Katie Koch. I'm the president and CEO of TCW, which is a global asset management firm. We manage about $200 billion in assets, and we're based right here in Los Angeles. So I think I had the shortest commute to this panel, which was very exciting for me. And then in terms of the asset classes that we're focused on, a lot of what we do is in credit, both private as well as public credit, and we also have a highly differentiated equities business. And I'll just end by saying I think the things that make us different is that we've been doing it for a long time. Rick Miller, our head of private credit, is here in the audience, and he's been doing it for 25 years, and we can talk about why that's an advantage in this environment. So certainly our longevity makes us different. We're also privately held, so we have an investment-led culture. And then finally, the combination of those two things mean that we build very differentiated portfolios. And we'll talk more about this, but we think this is going to be an incredibly fertile environment for active management, both in private and public markets.
So I'm Ron O'Hanley. I'm chairman and CEO of State Street. State Street is a large bank. We've been around for 230 years, but we're not really a bank, as you would recognize that we have one client base. It's the world's global institutional investors, and we either manage money for them or we service them in some way: custody, fund accounting, technology, infrastructure. And I have the privilege of actually serving a majority of people on this panel.
Very well, I will add. Amazing partner.
Okay, so let's dive right in. I thought we'd first talk about the American brand. There's a lot of chatter lately about whether it's been tarnished, whether the fact that we've got debt problems in the United States, our treasury market has been volatile, there's been troubles in the equity markets, there's confusion about policy in Washington and even some frustration at times. Has the brand been impacted, either short term or even kind of longer term, permanently? Why don't we start from Ron and go around?
So the new administration has really, using their own words, they've flooded the zone with a lot of policy changes, most of which were transmitted and told to us during the campaign. So at some level, I suppose we shouldn't be surprised. But I think what surprised everybody is the degree to which it's happening, the way it's being implemented. And I think it is fair to say that because of the surprise and the uncertainty and some of the tactics and maybe some of the rhetoric around it, that the brand, whether it's permanently tarnished, it's definitely tarnished now. Part of it being that institutions aren't sure how to behave. When you start to conflate things like tariffs and security arrangements and statehood and Greenland, it becomes really difficult for people to operate. I think the real question is whether this is permanent or just as these things are actually being implemented, and that we don't know yet.
Okay.
So one observation I want to make, and you and I have talked a little bit about this, is that many of us up here have the privilege of being on the circuit. So we go to these landmark conferences all year, and we were reflecting that at Davos, which was in January of this year, the mood was unbelievably optimistic about America, American hegemony. The Europeans were feeling very bad. You'll have to give us the perspective from Brazil, but America was going to win everything, and the animal spirits were coming out. And now we're really at the opposite of that in terms of sentiment.
It's remarkable how much things have changed so quickly.
Yeah, and how wrong consensus usually is, too. But I would just say here, one thing I want to make a point about in terms of whether or not this is permanent, I'll say two things. The first is there's this narrative that we need to embark on these policies because somehow we were losing. And I just want to remind people in America, we have 5% of the world's population, we have 25% of the world's GDP, and we have 70% of world equity market capitalization. So actually, we've done a lot of winning already, and we do have a lot to lose. And I think that goes to Ron's comments, whether this is short-lived or longer-lived. The second point I want to make, and I want to give everyone a chance to weigh in, so I'll just say this briefly. The one thing that makes me optimistic that we're going to keep this on the right track is actually the bond market, because every time we've done something to really either risk our central bank independence, which we can talk more about, or do something that we thought would be catastrophically bad for growth, the bond markets reacted quite violently, and we've course corrected our policy. And so that's one reason to believe that we might be able to keep the train on the tracks here.
Look, I would echo what Katie's saying, that we're starting from a position of the United States having been the winner for a very long time. US equities absolutely crushed every other country's equities for a very long time. And people around the world have gotten to a position where they're extremely exposed to the United States. If you look at every dollar crossing the border, going from anywhere to anywhere, 70 to 80% of cross-border dollars are coming into the United States. So we're starting at a position where everybody around the world holds American assets as extremely exposed to the United States. That means two things. One is that the United States is incredibly vulnerable to that going away, because that's the flip side of the trade deficit, right? If you have a huge trade deficit, there's money coming in on the other end of people buying our financial assets. And as we've seen in recent weeks, those capital flows can move a lot faster than trade. It takes a lot longer to correct trade, and that vulnerability is just not going away quickly. The second thing is, look, it's hard to see past any one policy, but if you take the mix of all the policies, they clearly reflect a broader ideology that the role of the US government is really to support US wealth, US strength and defense, US self-sufficiency in a way that crosses any one thing, crosses just tariffs. That's why you're getting these policies that are kind of mixed, that say, well, I'm doing the Ukraine work, but I'm also doing it from a perspective of trying to get material wealth into the United States. And I think when you look at this broad ideological shift, and some of it's been going on for some time, a shift towards a new ideology, a rejection of what came before it. It's very hard to imagine that any of the United States' friends and allies, whether it's at the government level, at a company level, could take any announcement of any one policy and say, we've gone back to where we have before. Because the shift feels more profound than that. There's no one shift in policy that would kind of bring us all back. And I think the thing that is really sticking with folks when you talk to folks around the world is the understanding that the United States does not feel like a reliable partner the same way. Reliable security partner, reliable trade partner. You have to ask yourself, if you were in the shoes of anyone around the world, how much would you bet your country, your company, on this being the reliable partner? So I think it doesn't really matter exactly where certain policies will land, that the mindset shift that other countries look and say, the United States wants to be self-sufficient, maybe we should be self-sufficient too. Maybe we should worry about this much reliance on the United States, starting with a point where all of the cross-border money was coming in here and the exposure was so high. Very hard to imagine that reversing. If you already have 75% of your exposure in the United States, are you going to go higher from here, or are you going to rethink maybe slowing that down?
Thank you.
Yeah. Well, the objective answer of your question is yes. There was some change in U.S. brand globally. Katie remember pretty well the Davos consensus, which was very useful because it's generally wrong. So it's good to know what it is to do the opposite. And that was, we finished last year talking about U.S. exceptionalism. And after 2 years of equity markets in U.S. returning 20% plus, huge wealth creation in U.S. tech, huge perception of innovation in U.S. So it was extremely successful markets and society. And we moved at that from a drastic change in economic model. The first question that come up to a normal analyst, especially outside U.S., is why, right? It's so there is an issue about why, if we are doing so many things right, if we have so much achievement in these last 20, 30 years, why changing drastically the model? And this idea about trade deficits being an export of wealth creation, it's a little bit disturbing. If you go back to early 70s, where U.S. started to have structural trade deficit, since today, no other country was as successful as U.S. So factually, it's not true, right? Otherwise, there would be other U.S., other dollars around, and nothing like that is happening. So how permanent is this damage? Of course, time will tell, evolution of policy will tell, markets calm down a little bit. But what we are seeing, in my view, is in the last 3-4 years, U.S. worked as a financial black hole, attracting capitals from everywhere, no matter if it's Europe, emerging markets, China, neighbors, whatever, for a good reason. Where else in the world one company would create $2 trillion of market cap in less than 24 months? Only in US, the case of NVIDIA, for example. So what I think the instability, uncertainty of these last 3 months created is a sense of diversification needed globally. So suddenly people notice that eventually, after these 4 years of amazing success, or 5 or 3 years, depending on how you want to cut the time, people notice that eventually they have too much US, too much dollar, too much tech, and what we are seeing is a little bit of a spillover from US, the rest of the markets. I don't think this is permanent. I think the quality of US economy and society is huge. Recession fears maybe are too extended, so, and we can fix that. But there was, every time that you have uncertainty, unpredictability, you have this response of the markets.
Thank you. I want to have your view, but also the minister. I'm going to ask you 2 questions, if I could. A, to weigh in on our discussion, but B, just earlier I heard Jonathan Gray talk about the Middle East as an opportunity, and he seemed very excited about the Middle East, and the average investor might have been surprised to hear that. You hear about the Houthis in the Red Sea. You hear a lot of turbulence and turmoil. So for Jonathan Gray of Blackstone to get excited about the Middle East, I found that interesting. I'd love for you to weigh in on that if you could.
Well, on the first topic, I agree with everything that has been said, and I will not repeat it, but I'd like to step back and just put it sort of in a broader context. And first of all, let us acknowledge that brands of countries certainly is not static. It's evolving and it's moving with historic changes and trends that are taking place. And even forgetting the developments the last couple of years, the brand of the US 5 years ago is very different from the brand of the US 60, 70 years ago, post-World War II. And I think what we're going through maybe appears to be a little bit, volatile, but I think it's a continuation of that evolution. And I think that change within the US of economic policy, of industrial policy, of trying to wake up to some of the imbalances that has taken place is also part of a developed versus emerging market trend that has been taking place for the last 2-3 decades. The G7 used to be 60% of global GDP. They have shrunk significantly the last couple of decades. They're 40%. And although they're growing much less than the markets that psychologically maybe the West and the developed world have thought of in the past as markets, as less unable to innovate and manufacture. And that certainly has changed. There has been sort of a democratization of some of the things that psychologically Western countries, include the US, thought they had them forever. And you're seeing many countries today are able to innovate on their own and compete. So, and then of course you have the demographics and that spread of development. That is of course going to create some of the friction and tension that we have seen in Europe and here in the US. Having said that, I will just double down with what Katie and Ron and others have said. There is no close competitor to the US in many aspects, certainly capital markets, their depth and their breadth, and also the innovation spirit. I mean, the last 3-4 years, there is not a human being on the planet that is not talking about the next tectonic shift in how we live and how we do business and how we govern, driven by AI, which is primarily a US innovation, and this is replicating many previous revolutions, including globalization, which was actually driven by US policy, which has brought so many people from being peasants around the world to being the developed countries that are competing with the US, who has driven many of the policies. So I believe ultimately, as always, the US will do the right thing. It's a country of institutions. Our trust in the US remains strong, and we continue to work with American companies, with US institutions, financial institutions, leading that level, but we also invest in the US for the reasons I mentioned. In the Middle East, I will just say at this outset that we have built over the years, for unfortunate reasons, a lot of resilience, because we're used to shocks, we're used to security challenges, and we have the mechanisms, policy, political, security, but also economic, to absorb different types of shocks, including economic shocks, and certainly as a result of the global economic turmoil that is going on now, we've seen that transmit to many of the resource-rich countries around the world, including in the Middle East and oil commodity prices. But we've seen this before. This is not the first time, and it's not going to be the last time. We have the financial buffers, we have the tools to absorb this and expect a shiny day very soon, inshallah. So in terms of the specific disruptions in the Red Sea with logistics, we have minor adjustments in how our goods flow from the Red Sea to the Gulf. But all in all, it has not slowed in any significant way economic activity in the kingdom. And I can tell you, as Minister of Investment, we're seeing very healthy investment continuing to happen in the kingdom. A lot of it is local, driven by our private sector and our sovereign wealth fund, but a significant growth year on year from foreign investors who, just like Jonathan Gray, do believe that in the overall balance of things, there is more opportunity than risk in the right countries in the Middle East. And we like to think that GCC in general and Saudi Arabia in particular provide those good trade-offs of risk returns.
Interesting. And you have demographic advantages over many
As well
other
as demographics.
continents, I would think. All right, I'm going to put Karen on the spot here. Karen, recently you said as follows: we're in a once-in-a-generation economic shift that threatens the existing world order. Sounds pretty ominous. I'd love to hear you explain what you meant by that.
Well, look, I think if you look at the perspective of financial markets, right, there has been one paradigm that's existed during the entire lifetime of investors. So you could look from World War II at the US leadership security umbrella. You could look from the 80s at the world of globalization, disinflation, the way that supported global companies and global profits. Or you could look at the last 15 years and basically look at a period that's been incredible, most importantly for US equities. And the sum of all that means that that paradigm is so ingrained into investors around the world. And it means that portfolios have shifted more and more and more and more to buy the things that have done well, to move more and more into more equities, more liquids, not have anything else in the portfolio, be extremely concentrated in the US, extremely concentrated in tech. And I think now's a good time to kind of shake yourself and say, do you really believe that the future paradigm looks like the one in the past? And when you look at the philosophy that's being articulated, we've called it modern mercantilism, because I think it is a modern version of that that really says, no, the role of the state is much more self-sufficiency, its own strength, its own wealth. And you think about where that means the world is going. We've been on this journey for a while. It's just been slower, and the Trump administration has accelerated it. But the last few years, starting with Trump 1, we've kind of shifted more and more into globalization started stagnating. We started having more and more signs of different trade barriers. We started moving more towards prioritizing national wealth and strength. Now it's accelerated, and it's accelerated in a very chaotic way that's created a lot of uncertainty. But it's a good wake-up call to say, do you really want to bet that whatever you hold in your portfolio, it's so clearly set up for what the last paradigm was? Do you think that's what the world is going to be in the future? And I would say that from a perspective of geographic land footprint. There's very little geographic diversification. People are very US focused. And it really makes you think maybe there should be more of a risk premium on US assets, and do you really want to bet on just one region? I'd say from a perspective of kind of environmental diversification, how much are you betting that we'll continue to get extremely strong growth that's disinflationary when the whole world's moving towards these very inflationary policies and kind of shifts? I'd say from a currency perspective, which is people are extremely exposed to the US dollar, and that's been a great winning trade. So I think it's a great moment to say, how do I make a portfolio that's actually resilient to the world potentially looking pretty different? Because there's a lot of signs that the world is going to look pretty different.
Interesting. And speaking of new paradigms, you hear a lot of talk about alternative credit, private credit. We are shifting in that direction. Katie, you've spent a lot of time in that area. Tell us kind of where this can go, where it should go, what the opportunities are, or maybe what the risks are. Is there too much hype?
Yeah, so just to build on Karen's comments about new paradigm, that is good news for a lot of Ron's clients and us in particular in active management, and it creates volatility and opportunity that we could say has been more subdued over the last 15 years, because if you're in a one-way rate environment and a one-way growth environment, except for a little hiccup in 2020, this, in theory, should be a great environment for active managers. And I think alternative credit's obviously part of that. So what would I say about this? I think big picture, just because not everybody's as familiar with this asset class, very, very big picture, public equity markets in the US have been massively disruptive by private capital the last 20 years. So Karen talked about concentration in US markets and into the tech companies. It is also true that as private markets have taken share from public markets and equities, we have 50% less companies than we did 20 years ago. And it's a pretty simple decision for a CFO in the equity part of the capital structure to be public or to be private. You asked about alternative credit. I just want to say that we think we're at the very early stages of those fixed income markets being disintermediated, the public markets by the private markets. And actually, it's a much more complicated financing decision for CFOs in the credit part of the capital structure, because you can be both public and private at the same time. You can actually be IG and non-IG at the same time. You can lend against your corporate cash flows. You can lend against your assets and do something securitized. You have a lot of options of how to finance yourself. And so from an asset management perspective, what we're always trying to do is to be relevant to the borrower. And so this asset class, private credit's existed for a long time. Most people have only done it post-global financial crisis, but it has been around for a couple of decades. Asset-backed finance is more recent. Dylan Ross, who leads that business for us, is with us here today. That's going to rise in terms of asset classes. To give people context, and I'll end with how you are successful in this asset class, private credit, which is non-IG, it's the private substitute to the high yield market, is now as large or bigger than the public high yield market. Asset-backed finance is in its early stages, so call that 1.5, 1.8 trillion. Asset-backed finance is probably a $20 trillion addressable market. So I think the way that people's portfolios look like in fixed income is going to change dramatically over the next decade. I just want to end by saying, around this volatility and this uncertainty, as money has come into the alternative credit space, and a lot of it has come in the last couple of years in the early evolution of this changing, there's been a lot of optimistic lending happening. And last year we made that point very aggressively from TCW that we were seeing a lot of optimistic lending and underwriting happening. And we were seeing weakening of covenants and documentation, because as money comes in, people need to put that money out. And I just want to end by saying, I think, and Ron and I were talking about this earlier, we are going to see a massive dispersion in the performance of private credit managers and what they've bought over the last couple of years. So that's going to be interesting. It's going to matter a lot who you hired for private credit in terms of the performance of this vintage in the last couple. And also, because of macro stresses that are coming, which we can talk more about, we think these could be, while it shouldn't be a vintage-sensitive asset class, this could be some of the most interesting times and best return availability for private credit. We can unpack more why that's important. But I just want to end by saying what we're trying to do for our clients is a very conservative approach to lending. We are doing true middle market lending. We are doing it very covenant heavy. We're doing it very diligent heavy. We're saying no a lot. We're deploying very deliberately and very slowly, and I think that's going to turn out to be a very winning strategy in this market. And because of this macro stresses that have already been pointed out on this panel, we are now going to start to see some of the accidents in this asset class, which obviously I think we've set ourselves well up to avoid.
Ron?
Yeah, one thing we should do when we're talking about private credit too is, we talk a lot about the risk, but just remember it's an extraordinary innovation, and remember why it got such a boost. Katie's right. I mean, this has been around for a while, but was propelled, and a lot of the innovation we see really came out of the 2008 crisis. And remember what happened in 2008. There was an immense concentration of risk in banks, and we saw what happened in terms of a financial catastrophe that then turned in the investment and financial economy that turned into a real economy of really prolonged recession. Private credit is actually the opposite of that. It distributes risk away from banks. It avoids the concentration of that. So there's probably reason to be concerned about it, just like if you were able to look into bank loan portfolios. Some loans do well, some loans don't. Some banks are better underwriters. Some bankers are better underwriters within banks. So you'll probably see this kind of dispersion, which really does come out when you see some kind of economic downturn. But the positives of all this are, one, what I just talked about, this distribution of risk. Two, it enables developing economies that really need more capital beyond which their banking system can support. You have a situation where the banks, they'll have their own balance sheet, they can originate loans and then put them out into the private credit market. So this has been an extraordinary innovation. It hasn't been tested through this kind of thing, but what we do know is it won't be the same kind of 2008 crisis. It may be a workout kind of thing that we're going to have to figure out how to do that, because a lot of these firms don't have workout capabilities. But you can't underestimate just how important this innovation is to, one, address the problems of '08, but two, to enable economies like Saudi Arabia to actually propel their growth.
Just to follow up, are we at the point where an Apollo or a Blackstone is too big to fail, and we think we've dispersed the risk, but those guys are enormous now. If they run into problems, doesn't the Fed have to step in, or the government?
But remember, I mean, it's not on their balance sheet, right? They've got, well, in the case of Blackstone now, probably thousands of, tens of thousands of investors.
Yeah.
So yes, if things go bad, those investors will be unhappy. But in terms of a kind of catastrophic concentration of risk, no, it won't be that same kind
That's
of
a good point. That's a good point. Let's talk about, it's a macro panel, let's talk about the Fed and interest rates. A few weeks ago, the president was public in his unhappiness with Chairman Powell. He took a step back and doesn't seem like anything is imminent in terms of pressure, but there is reason, one could argue, maybe to cut rates. I'm not clear with the economy slowing, maybe there'll be more pressure from the president or the markets. I'd love to kind of hear a perspective on the Fed and treasuries and interest rates. Who would like to start? Andre, would you like to start?
Well, coming from Brazil, we are used to this kind of comments by our president. But having said that, I think President Trump moved fast in criticizing, then coming back that it was just a normal criticism, which is part of the game. I think there was too much of noise around the recession risk, and the latest economic indicators are not telling us that we have a recession imminent. Of course, if we have this tariff deadlock, let's call it this way, for a long period of time, yes, we do have some real impact. For the moment, we have more uncertainty, and I don't see the Fed doing an improper job. And by the way, the arrangement of the Fed, I think, has been proven for many decades in different markets, different economic cycles. It's normal that central banks and central bankers commit mistakes. It's part of the action. Maybe we were too slow to raise rates and eventually reduce rates for too long during the recent years, stay at zero very, very long time, and QE and too much excess during the pandemic. But it's part of managing a complex environment in a complex economy. So I don't see anything abnormal at the Fed. In the treasuries, I'm more reflective about what's happening. And if you read any academic work about U.S. monetary policy, you would see that neutral rates in U.S. is about 1%, or most less than 1%. There are a lot of qualified economists here in the audience, and could say that the neutral rates is below 1%. And for a while, we have been looking at the inflation-linked bonds of U.S. trading around 2%, maybe higher sometimes, maybe lower sometimes. So I'm kind of reflexive about this new risk premium, if you want, in the U.S. Treasury yield curve. Of course, there is more conversation about the U.S. deficit, which I think is good. I remember last year when we were debating, or maybe in another forum that we debated here, we have been talking a lot, some of us here in this panel, we talked about U.S. deficit, and it was the elephant in the room and nobody noticing. I like what I see in terms of debate, not necessarily the achievements of Dodge, but at least we are facing the problem, and it's now a part of the discussion and a proper economic discussion. It's not, there is a limit for that. Even if you are the owner of the printer, there is a limit to print. So you need to address this issue. And I'm curious about the Treasury development. I don't think we have a red light, but a light yellow light on that.
I think that a global economic slowdown, not necessarily a full recession, but certainly a slowdown, is absolutely baked in the cake at this point. And it doesn't matter exactly where we land on tariffs. I don't think anybody here could say they know exactly where we're going to land. The thing that's most impactful right now is the amount of uncertainty that's been created. Because if you put yourself in the shoes of any business around the world, it's extremely hard to make a capital expenditure or an employment decision right now. I mean, how can you hire people? How can you start a factory when you genuinely don't know what's going to be economic, what's not going to be economic, when that will be settled? And I don't see any one announcement on any tariff-specific policy creating sudden certainty to say, I can go make long-term decisions now. So we've kind of shifted to where the biggest effects are actually the uncertainty effects are likely to be worse than the actual effects of the policies, assuming the policies land somewhere reasonable. The policies could also land worse than that. So if you get that slowdown sort of flowing through, back to the Fed part of the question, I think the Fed is in some ways in the toughest position of any of the global central banks that'll be facing that slowdown. Because in most countries, you're going to be looking at a slowdown, and you're not going to be looking at a big bump in inflation. Unless they do big retaliatory tariffs, this isn't a big inflationary event. So you primarily can just look at the slowdown in your economy, ease into it. If you're the Fed, at the very least, you can't be proactively easing into the slowdown as they have been doing, and the Fed has been quite proactive recently because they know they're going to see prints that are much more inflation. They're already going to be sitting there with prints that are, 4% type inflation prints, and it's going to be hard.
Because of tariffs?
Yeah, because they're going to flow through. I mean, again, we don't know exactly where tariffs are going to land, so it's all probabilistic, but in the United States context, it's very hard not to see prices flowing through in a pretty mechanical way. And while it's very sensible to say, look, these are one-time rises to do with a policy, that still pauses you from being extremely proactive, easing into a suddenly rising inflation number. And then in addition to that, you have the political pressure, but you also have what the dollar and the bond market has been telling you, which is, again, not yet a disaster, but kind of skirting the line of what it feels like to have balance of payments type market action, balance of payments crisis type market action. I don't think it's at the level where the Fed should worry a lot, because when we kind of started this, if you said to me 3-4 months ago, what do you think the risk premium is on US Treasuries? I would have said, it's extremely low. It may be zero. I don't know if you're getting paid any risk premium to hold a US Treasury rather than being in cash. It's very hard to imagine what is this risk premium that's on Treasuries at a time where, as Andre was saying, you're writing enormous deficits and so on. So there's something healthy about saying maybe some risk premium is actually sensible. You should get paid some risk premium for holding these assets. But the speed at which it's happening, the fact that it's happening into all this uncertainty, the fact that it's happening with the dollar move, which tells you this is foreign-led kind of reconsidering US allocation, it's got to make the Fed at least pause and feel more tension. So I think there's going to be a global easing cycle, but it's going to be led not by the Fed, because the Fed is going to feel the most tension on how to respond to this kind of mixed set of pressures.
Interesting.
I'll just say, built on those comments, we would say likely they're going to be behind the curve. They're almost structurally tied to being behind the curve for some of those reasons. Briefly, the first is that the mandate's inflation, as we all know, and there's currently very inflationary policy being discussed, and they go off the data. They tell us that all the time, and we don't have data for this situation because it hasn't happened before. And so they're going to be waiting for that data to come out to see if it's a one-time reset. Is it more inflationary? What is the policy actually? What is the policy? How does it land? That's going to cause some delay. And second, we've put them in a politically impossible situation where they can't be seen to be capitulating to the direction from the government, because we need an independent Fed. And I think the current leader of the Fed understands that, knows the institution has to have credibility, and that is almost pushing them into a position where they have to stay where they are for longer.
Wow.
The reason that this I would also add to this, before any of this noise came out and consensus, as we said, was so wrong in January, we already thought the economy was weaker probably than fully being appreciated. And these things are a process. They take a long time to work through. But now you have potentially higher rates for longer, coupled with some underlying economic weakness. And that gives us pause around risk assets. Now, we came in very underweight credit. We were at our max underweight position in credit in our multi-sector liquid portfolios of 15%. And on the private side, we came in with a lot of dry powder. The short dislocation we were given this year gave us a chance to add to risk assets. That's what we do during that dislocation. But we've almost reverted back. Those of you who follow equity and credit markets, credit spreads have tightened, equity markets have rallied. And you made the point that, Karen, that like a lot of this potential weakness, or at least a lower rate of growth, has been baked in. But it's not been baked into asset prices. Asset prices haven't done that yet. We have kind of round trips. So we do think there's a lot of vulnerability here for risk assets because of a combination of higher rates, potentially slower growth, and the fact that we are still have returned to record valuations.
Okay, before we get to questions, I just want to have a quick answer I want to talk about oil and gas just for a little bit. I want to kind of talk about opportunities there. You hear a lot about alternative energy, solar and wind over the last few years, but maybe we're shifting away from that. Mr. Minister, would you address that, please?
Well, first of all, we have to acknowledge two things. Number one, climate change is not only real, very real. We're in Los Angeles, and we've seen the impact of extreme weather as well as the tragic fires here. So we have to be reminded that we do need to manage our emissions and reduce them, while also realize that everything around the world needs energy. And everybody's talking about AI and data centers and how much energy they need, but everything else needs energy, including our homes, winter, summer, around the year, every facility. And it needs to be affordable energy. So how do we manage this energy transition of introducing renewables, reducing emissions, finding mitigations to whatever emissions we have to emit, I think is something that is a collective responsibility. The other thing I would like to emphasize is it's not about being for fossil fuels or against fossil fuels. Fossil fuels are a precious endowment that humanity has. And today, if you take current consumption, we have 47 years of reserves in the ground. So multiply that by 2. I mean, let's be aggressive with technology, additional discoveries. It's still 100 years, and the nature of fossil fuels, given my experience, is it's going to decline over time if we were to double those reserves or the rate of extraction that is humanly possible. So if it's not for a belief in climate change, it's the ultimate depletion reality that's going to hit us. Maybe not this year, maybe not in 10 years, but it ultimately will hit many of us in our lifetimes and certainly the next generation. So we have this, I think, imperative to do the right thing. We have seen, unfortunately, that if we go too fast with introducing new forms of energy, that there are massive disruptions. We've seen that just a couple of weeks ago in the Iberian Peninsula, Spain and Portugal, because of the inability to manage the intermittency of wind and solar and matching it with intermittent consumption patterns. So that means, I think, our policies, whether it's COP policies, national policies, regional policies, sharing electricity grids, all of the tools that we have to put in place, investing in infrastructure, have to be really built for resilience and for managing not just the planet, which, as I emphasize, we have to do, but also our local, national, and regional energy systems.
Thank you. Thank you. We have got about 10 minutes for questions, or a few minutes of questions. Can't really see the audience, but if there are any questions, how are we doing this? Do we have somebody to take questions? No? Okay, great. So I have other questions to ask. We didn't talk enough about tariffs. Tariffs enormous importance lately. Some people argue that if we cut a deal with China, and we could, the markets will snap back even more so than we've seen. Things are back to normal. There's real excitement over that. Tell us about how worried should we be over the next kind of period about tariffs. Ron, do you want to start?
Well, I mean, if you think about what happened on April 2nd, which was quite chaotic, I suppose we should be very worried. But I think what you're seeing now is not unlike many policies out of this administration. There actually is a policy underpinning, but the way it comes across is actually quite confused, if not chaotic. So I personally believe what's going to, and remember, in some cases, we're actually trying to accomplish many things with tariffs. So with China, there's a whole superpower rivalry going on there. There's lots of other issues with China. Even with Europe, I mean, there's this, it's been conflated with the whole security arrangement with Europe, and Europe's not paying enough, so therefore we're going to extract tariffs from them. But I think going back to what Karen was saying earlier, in some respects, this is a natural outgrowth to the last 50, 80 years of what you've seen, which is an extraordinary globalization, an extraordinary lifting of aggregate standards of living. And this is where both the left and the right would actually agree. They just don't use the same language in the U.S. But a lot of people have been left behind in the U.S. And the left and the right talks about it differently, but that's the fact, right? And it's you've seen, again, billions of people lifted out of poverty. But when you look at the U.S., aggregate wealth is way up, but you see real broad swaths of the electorate, of the citizenship that's been left behind. So that's the other underpinning for tariffs. So again, because there's so much trying to be accomplished, it comes across as very chaotic. And I do believe what we'll see is a few, they won't even be deals. There'll be agreements in principle or agreements to agree. That will start to set a framework for others. You'll start to see things calm down. But to Karen's point, this is one person's opinion. Nobody, myself included, can sit here and predict how this is going to be. And there may be wishful thinking and all that. But you have to go back to, in many cases, the objective function is multiple in this. And that makes for confused policy.
I like that. Anybody else want to weigh in before we get to the questions that I should have looked on this iPad to read?
I'll add, I do think you should be worried. I also agree none of us know. The people that know may not know too. I don't know, it changes a lot. But at the current deal between, let's just take US and China, because it's the world's first and second largest economy, at 145% tariff, that's not a tariff, it's an embargo, right? So we're ending trade between the two largest economies if we don't make progress. So hopefully we make progress. Second thing I want to mention is just the fact that who this hurts in America is actually important for the employment picture. It's actually small companies that are the least insulated from these tariffs. I think it's important people acknowledge that because it's harder for them to shift the supply chain, to state something obvious. And so that, in a lot of ways, can hurt them the most, and small businesses in this country generate most of the employment. So we should be watching the pull-through of this into the employment picture. And then just ending on this comment of dispersion and opportunity, the thing that we think a lot about in the public and private credit markets is if you were to take a chart and most exposed to least exposed to tariffs on the x-axis, and then on the y-axis you put companies' exposure to the macroeconomics or risk of recession. You know, to state the obvious, you want to kind of avoid the ones in the left-hand quadrant, which are both exposed to economic weakness and tariffs, and pick ones up in the right-hand quadrant. And I think you're going to see a lot of dispersion on that as we figure out the tariff situation, and therein lies some bottom-up security opportunities in both private and public markets. And I do think, I just want to end by picking up on something both Ron and Karen said. Regardless of how we end up figuring this out, this comment about being a trusted partner and what this means to the business community and people wanting to deal with America in the absence of some certainty. It's not a foregone conclusion right now that we're going to have a recession. We could work our way out of it between a combination of the kind of economic policy and, well, let's say the Fed policy and also what the corporates do. But every day that the business community does not know what the plan is another day of delayed business spending, delayed M&A activity, et cetera. And so I think if there is a grand plan, it would be good for us to know sooner rather than later. And every day that we have uncertainty, yes, it creates idiosyncratic opportunity. That's great for active management, but it puts us one day closer to a potential recession. And I don't think this thing is going to get fixed until we have certainty.
All right, this seems like a consensus that we have an economic downturn of some kind coming. All right, let me get to a couple of questions. I'm going to combine two of them. What is your most contrarian view, and somewhat related, make the case for continued U.S. exceptionalism? Is it AI? Is it something else? Who wants to kind of tackle either or both of those questions, somewhat related questions? Here we go.
Okay, happy to. I think by far our most contrarian view, which has been a huge winner in success, is that you really want to have some of your assets in Asia and even in China if you can, because it is the most diversifying thing you can hold. And these are countries that are just having different cycles at different times, different exposures, and there's still a way to invest there and get the diversification you need.
And performance too?
Performance has been very strong if you invest in a way that doesn't have you exposed to just one factor. So if you only invest in China, for example, by buying like just the Chinese stock market, you haven't had a great year. If you invest in a more balanced way, it's been a great period. And then I would say that, look, I think there's a lot of cases for U.S. exceptionalism. I think it's, we can start listing them. AI, the companies have been incredible at creating return to capital. The problem is that those are very much in the price, meaning everybody already believes that. It's already in the price of what you're buying. So you don't just need American exceptionalism, you need it to be even better than the last 15 years have been, and they've been pretty remarkable. In other words, if we get a repeat of what we just got, U.S. assets are going to do okay, but they're not going to be amazing. 15 years ago, they were not priced to be so exceptional, and that's why we could do so well, but that got baked into the price.
Okay, under them, Ron.
I think U.S. exceptionalism we should understand not necessarily as a short-term price performance in the markets, right? And I don't think it's that difficult. It's just going back, not necessarily with less government of the previous government of 10 years ago government was doing, but it's following the development of U.S. society, right? Which is follows the dynamic of an open society. Innovation, fantastic education, entrepreneurial spirit, low taxes, and that's the direction. That's what transformed or made this country the most successful country in the world. That is clear.
And we still have
it's not an accident that the dollar has the dominance. It's meritocratic achievement of what has been done, not for government X, Y, Z, but in the last 200 years of reasonable political consensus. So it's not difficult to come that. So we need to revert back this mercantilism policy. And again, doesn't mean that you don't have some hard truths that you need to face, right? It's eventually there are tariff imbalances, or why you have TikTok in US and you don't have WhatsApp in China. So we have some interesting debate of European security in terms of geopolitical, some valid and interesting debate. But the way that you put this debate makes a lot of difference. And it's important to understand what brought US to this point where we were discussing exceptionalism. I agree with Karen that markets are too extended, even if you're doing the right things, or were in December, a little bit less now, but it's still too much priced in. But I'm not talking about 1 year or two, but the trend, and it's not difficult to go back to the right track.
Ron, you want to?
My contrarian bet is I would be betting on the UK right now. I think that in some ways, if you think about Brexit, it was an awful lot of preciousness going on the part of both the Brits and the rest of Europe. And I think that given the situation now and this, whatever you want to call it in terms of the distancing from the US, I actually think that you'll see a form. Will they join the EU? Probably not. But functionally, will they get all the same benefits out of that? And will now this a great trading partner, be reunited with the EU. I think it will be, and largely to the benefit of the UK.
Interesting. All right, we have a minute and a half. I'm going to ask, there are two related private capital kind of questions, and I'm going to kind of ask Katie to answer them. Won't private credit perform just like high yield in an economic downturn, highly correlated to equities if growth disappoints, and it's expensive asset class as well? Feel free to spend a minute and 11 seconds.
So that person really likes private credit, whoever asked that. So two quick things. We talked about two things: asset-backed finance, private credit, which is direct lending. In the asset-backed finance space, actually one of the reasons people want to get access to this now is that you can get excess return over IG. You can structure it as IG or as MEZ. And it's self-amortizing over 3 years. So it doesn't have a lot of duration. It actually has very low correlation, the way it's structured, to equity markets. So I think that this is going to continue to grow in importance because of what Ron said. There is demand from the client base, largely insurers, and there's supply as more things can be securitized in the private markets. We continue to think it's a great asset class across the quality spectrum. In private credit, will it be like high yield? Currently, the default rates are much lower than high yields. Part of that is because of this amend and pretend and extend. I think it's going to continue to be, we think, an incredible asset class over the next 10 years with great return potential. And there's no bubble or any, we think it is structurally extremely attractive. More of the CUSIP high yield market will move into private credit. People should have exposure there. At the same time, the question about high yield and is it correlated to equities, if what we said is true, if rates stay higher for longer, if the economy is weaker than people think, there will be some idiosyncratic pain in this asset class. The default rate is understated currently because of these LME exercises. It will go up, and so who you invest with is going to matter a lot. And I'll just end by saying, I said it before, but I want to emphasize it again. This should not be a vintage-sensitive asset class. It should be something you have a continuous allocation to. However, because of what's going to happen here with liquidity needs, you're going to be able to step in and dictate some very favorable terms in private credit and also particularly in rescue financing. And this is actually an incredible time to be involved if you put in the right protections that the asset class is supposed to have.
Thank you. So I'm going to summarize some themes that evolved from the panel. Economic downturn is coming. We have too much money in U.S. assets. The Fed's behind the curve. Risk assets are expensive again. Asia and UK are attractive, and private credit is still attractive. Thank you. I want to thank the panel and everyone for sharing their thoughts.
Thank you.